Kyle, you want to give a little bit of an update on where we're at with the political debt ceiling?
The political, there it is. That's kind of the key, right? It's the hot potato that they want to pass around or kick down the road or wait till the last minute to get as much leverage from one party or the other party as they can. It's like you said before, it's a political bargaining chip now.
Hey, welcome again. Strong Valley, another monthly Market Matters. We've made it through a couple of months, through the first quarter and now through April. And just thought we'd do our customary recap on what we saw in April and maybe what we're looking forward to in May and for the rest of the year. So I'll kick it over to Kyle here to start. Just how the markets have done here throughout the beginning of the year, Kyle, and in April in general.
Yeah, thanks, Adam. It's been one of those years. It's been a little quieter. There hasn't been a ton of headlines, a ton of volatility. I was looking at something recently that we've only had 2 days this year in the markets that the markets moved plus or minus 2% in a day. Whereas, we had over 20 of those last year. So it's kind of off to a more stable, slow start this year, which is welcome from the volatility and the downside that we saw last year. But just kind of recap like we usually do is kind of the numbers and what we're seeing here for the year and for the month. So kind of year to date, the Dow's up right around a little over 1% through the end of April. The S&P's up around 5.5%. NASDAQ, which is our tech heavy area, has really been the story of this year. Comparing between last year and this year, we were talking about value driving the markets and NASDAQ getting hit real hard with high inflation and rising rates and the technology sector just not doing well. They're actually positive almost 15% for the year. So it's definitely been the key area that's been driving returns in the stock market, whereas the kind of the more stable value positions have been a lot more, not much excitement to them yet this year. So kind of update too on the global markets. Global markets, as far as the MSCI world, is up about 8% this year. So it's off to a good start as well. And then our ag, which is our bond index that we always reference, bonds were really tough for us last year across the board. We had the worst year ever for bonds, as we've talked about a number of times and in client meetings, as well as these monthly market matters in our podcast. But they're up about 3.5% for the year. So a positive return so far in the fixed income area, on top of the benefit of the higher yield that we're starting to receive from the benefit of the rate hikes that we saw all last year. So, and the last area that we kind of like to focus on too, just gets brought up a lot, is the commodities. So obviously with inflation being high, it's trending down, that we'll talk about here in a little bit, but commodities are actually down this year around 6%, almost 7%. So that's something that was, positive for us and for our clients last year, but kind of tapering down now with the slowing in inflation. So in month of numbers, through April, it was kind of a quiet month. Dow was pretty much flat. The S&P was actually positive about 5%. So most of the return we're seeing for the year in the S&P came in the month of April. And NASDAQ actually retreated about 3% for the month. And world markets are around 1%, and bonds were essentially flat. So that's kind of just updating the numbers through the indexes in the areas that we kind of pay attention to and the clients are aware of for the month and for the year. But kind of key factors and news and things that have been driving these markets this year. One of the things, obviously, it's been front and center for a long period of time now. I feel like it's just constant with inflation or interest rates and even recession talks. All that stuff has been kind of front and center and driving the news here. And so it's nice to see that we've had a steady year over year decline in inflation. The most recent number that came out is that the year over year number was down to around 5%. It's nowhere near our target of that 2 to 3% range or historical averages, but it's come down a lot since that peak in June of 2022 of around 9%, I believe. So that's definitely been a positive thing that we've seen. And I think a lot of that we'll talk about a little bit later with the housing market as well and interest rates. But the other thing is we've kicked off earnings season. So that's kind of one of the things that started here in the last few weeks in the middle of April here. And so most of about 20%, 25% of the S&P's reported earnings. And so far, about 75% have beat on their earnings. So that's kind of a positive thing to see, but still kind of below the average of around 77%. So we'll see how that transpires the next few weeks as the rest of the earnings come out. But that's been a positive to the markets, and we've seen that kind of cause some spikes, especially the last couple of days in the NASDAQ area with some of the tech companies coming out with better numbers than were expected. So, and then the other number that just came out this week that's kind of been a thing that people were looking for and talks regarding the recession was the first quarter GDP numbers. So that just came out on Wednesday, I believe it was, or actually Thursday it was. And so we actually had a rise in GDP of around 1.1%. Definitely not something that's very high or positive, but it's not negative. So there is some growth in the economy still. So the estimate was around 2%. So it is, underperforming what people were expecting. But from the big recession talk, and one of the measures that we have as far as regarding recessions is the GDP growth and 2 negative quarters of that. And so the fact that it is positive for the first quarter does kind of continue to push out the talks of in fear of recession in the short term as far as the first or second quarter, now that we've had that positive growth. So, but again, that's kind of just the news. We haven't had a lot. I mean, recently we were talking about the debt ceiling, and I think we're going to focus on that a little bit more later here. But that was also another topic that came out, but I don't really feel it's having much of an impact on the market because it's just been talked about for a little while here, and really not much going on yet. So, but key factor really is inflation coming down. And I think with that, we'll kind of kick it over to you, Adam, talk a little bit more about what you're seeing in impacts on inflation in different areas, different housing or T-bills and other areas.
Yeah, I think inflation coming down is a big driver, of the market, and that's been, a lot of the Fed and raising interest rates, and the lesser, talked about factor is money supply, which has gone down quite a bit, and all these are just levers, right? I mean, they're pulling levers to try to make things happen, but it's not a direct correlation. So when you see the Fed raise interest rates, or the different things that we look at, the inflation numbers, they're trying to affect inflation, but then you kind of got to see how it plays out, and that's kind of why this back and forth. And I know Kyle and I have said before, we just kind of expect this year to be a little bit bumpy. You're going to see some a little bit euphoria, excitement. The markets start coming back, and then you see negative news, and it kind of retreats. But so far it's been good, and we're hoping for a good rest of the year. So what we're looking forward to, or what we're seeing. So right now, one of the things is 1 month and 3 month T-bill. We've talked a lot about interest rates, and we will hear in a little bit about where rates are at. But there's a big divergence between the 1 and the 3 month T-bill, which is pretty odd. It doesn't happen very often because those are so closely locked together. And could be money coming out of banks. Banks are not paying competitive deposit rates compared to what you can get in money market or short-term T-bills. So that could be one of the factors. The other one we're going to talk about is the debt ceiling, and it gets a lot of play. And we talked about it. I think Kyle and I talked about this back in January. I think it's a little bit more of a political angle than it is an economic angle, but it does affect the markets, and that could be one of the reasons that people don't want to go out 3 months, because that's going to get right into that whole debt ceiling hard deadline. And like I said, we'll mention that here in a little bit. So we're definitely seeing a recession in housing. If you look at this chart here, median home sales price. You can see, 3.3% decline year over year. That's the largest since 2012. And if you look at the existing U.S. home sales, is another chart that we have. You got a 22% decline year over year, and we're at our 19th consecutive month declining. I know lumber prices have declined. We're definitely seeing a recession in housing. It's not a 2008 that type of housing crisis, but it can only go up for so long. Outside of coastal communities and things like that are maybe a little bit more insulated. Definitely down on sales price and on home sales as well. We're also seeing a little further decline in manufacturing and the services industry. So again, it all kind of plays into this, like Kyle was talking about. Are we going to see a recession, and how big is that going to be? And right now, and like we've said, probably still going to see a recession. A lot of these indicators are lagging, but may not be, and probably won't be, a catastrophic type thing. Because we've mentioned quite a few times, recession is just negative GDP growth. It could be slightly negative, or it could be majorly negative. And those are two very different things.
Well, that's like one of the things we've talked about, at least in client meetings. And I think I may have mentioned in one of the previous monthly market matters, but kind of the two variables that we watch and look for with recessions is kind of the depth and the duration, right? So just because we go into recession doesn't mean the world's coming to end, the economy's coming to complete halt, and we're going to have no growth in the market or anything for an extended period of time. So depth, meaning, how deep of a recession is it? Negative 1% or negative 4%? Or in duration, is it something that we're in recession for a couple quarters or, 3 or 4 years? And so I think what we're hinting at here is, what we're seeing is, yes, the likelihood of entering a recession is still strong or high. It may have been delayed another quarter. But nothing that we're seeing really is screaming, deep, long, prolonged recession that
Yeah.
leads to, massive destruction, if you
Yeah.
will, in the economy.
Put another way, we always talk about direction and magnitude. I mean, you could be going, you could be going down, but the slope could be, very narrow, almost flat, versus, heading straight down. So that's kind of where we're at. So let's talk a little bit about what is driving the market, and really has been for a while, is the Fed and Fed funds rate. So looking again at another probable interest rate hike, which again we've talked about, and we'll mention that is a positive and a negative, right? It cuts both ways. If you're a depositor, if you're an investor, that's not a bad thing to have higher interest rates and earn more on your money. If you're borrowing, obviously, if you're borrowing to buy a house, to buy a car, for any purpose, then it's more costly. So looking at about almost a 93% probability of, and I know this chart is not the easiest chart to read, but basically at the top there, you can kind of see that in the blue on the right-hand side, that's 5.3, so that's the May 3rd meeting. Right now we're at 475 to 5. So 5 to 5.25, and the way you read that is basis points. So again, 500 to 525 is 5% to 5.25%, and that's a 25 basis point increase, 0.25% increase. So it's about a 93% probability. The other thing that's interesting though is it's still a decent probability, almost 21%, that there's another 25 basis point hike in June. So again, still not off the rising rates trend yet. I said we're probably going to get one, and not likely to, but it's possible. And then I also put down here about a 99.9% chance we don't see more than 50 basis points. So we're probably not going to get above 5.5. And we call that the terminal rate. The rates you're probably not going to get above. Now, things can change. I mean, if things change in the economy, the markets, Fed can always reverse course. And again, this is just this is an investor, based on Fed fund futures. This is what investors think the probabilities are, but they're normally, as it gets closer to these meeting dates, they're pretty right on what's going to happen. So that's kind of where we sit right now. Figure another, if you got money market, I know we've taken a ton of money in cash. If you have money in banks and you're earning 40 basis points or 0.5%. Money market right now is 4.5. We're going to talk about that again, and you get another 25 basis point hike, and you just see things again start to trend up on that level. The one thing I do want to show real quick before we move on our rates is the dot plot, which is the Fed funds dot plot, and this kind of gives you a where the members see rates going in the future. So again, the one I just showed was more of a short term. This is more of a long term. So you can see 23, we're probably going to top out on rates. And by 24, we're going to be going back the other direction. It's just a question, is it late 23, early 24, mid 24? And then obviously the farther you get out, the less accurate, I guess you would say this is. But again, we do see that, hey, we're probably topped out on rates, and then probably moving down over, the next 12 to 18 months and beyond.
Yeah. And Adam, that kind of ties into kind of what we're talking about too, as far as, cash that's come in and interest in higher rates. Like you said, deposits aren't getting paid. They're not paying much at the bank still. So people have been moving money to T-bills, CDs, our money market. And so we've talked about that a lot recently, but we'll kind of give you a little bit of update on some of the current rates we're seeing here towards the end of April. Again, these rates, especially the T-bills in the short term, they move daily. So the 3 month, the shorter the duration, the 1 month, 3 month have, more of a significant movement from day to day versus the 1 year. But just kind of where we're at currently on rates here, I'll pull them up here. As for our money market rate here at Schwab is right now, as of yesterday, the end of April, was around 4.67%. So still, great interest that we're getting on that. But the reason we kind of want to point that out in conjunction with what we're talking about with the Fed funds rate is, and I know Jason, I think, is the one that's mentioned this in one of our other podcasts or monthly market matters, is it gets to be a point in time when the Fed stops raising rates that we hinted as kind of forecasted, and eventually begins to lower potentially in the fourth quarter. That's kind of when we start looking at that time that makes sense to go from something like a money market that is, benefiting from rate hikes, but will also go down on interest when they start lowering rates, to potentially locking money up for extended periods of time, whether it be 3, 6, 12 months for CDs, for that money that clients or people that are truly sitting there on that have no intention of using over that time period to lock in that rate before they kind of start going down again. So that's something that we're kind of looking at here in conversations with clients versus just all short duration stuff. So
for sure. Also, Kyle, the opportunity with treasuries is, state tax free.
correct.
So, look at short-term T-bills right now are similar rates to CDs, but you don't pay state tax. Now, maybe it doesn't matter if you're in Florida or Texas or somewhere, but if you're in California like we are, or, some of the other high tax states, that's a pretty big difference. So treasuries and CDs are right at about parity right now.
Yeah. So, essentially 3-month treasuries is right around 5.16%. The 3-month CD is about 5.14. So, there's not much difference there other than, like you said, the tax equivalent benefit of the state tax free on that. And one of the things we're pointing out is that it's still greater interest or higher interest at the shorter the duration right now. So everybody's pretty much aware that eventually rates are going to start dipping down. So when you start going out 12 months, they're not going to pay you higher interest for that, because obviously most people are, factoring in the rates will come down at that point. So the 12-month treasuries around 4.78. So, about almost a 0.5% lower than the 3-month. And with the CD, it's, the 3, 6, 9, and 12-month CDs are all within, 0.08% of each other, anywhere from 5.14, and then the 12 months 5.10. So not much difference there. So it's just a matter of how long you want to lock up and get that rate. And again, those remind clients too, those are annualized yields. So some people buy a 3-month CD and put $100,000 into it and expect to get that, 5,000. It's the annualized rate equivalent. So,
and again, definitely not recommending this, to everything cuts both ways, to go back to, we're still at 5% inflation. Mm-hmm. So all of your investments definitely shouldn't be cash. Effectively, you're barely keeping up with inflation. You're not making any money. But for your cash, instead of keeping it in a savings account or checking account, this is a much better option in addition to your investment portfolio.
Like Chris always says, shop your cash. So.
Absolutely. Right. So you want to? So I know Kyle and I again talked about a little bit of a rehash, but also things have changed since January, right? With the government, and we talked about the debt ceiling and what that meant. And now we're into April, and that's still a pretty timely topic. So, Kyle, you want to give a little bit of an update on where we're at with the political debt ceiling?
The political, there it is. That's kind of the key, right? It's the hot potato that they want to pass around or kick down the road or wait till the last minute to get as much leverage from one party or the other party as they can. It's like you said before, it's a political bargaining chip now. But it is a little more timely in the sense that just the end of the month here on, I think it was Wednesday or so of the end at like 26th or something like that. The House did finally pass their resolution or their bill to raise the debt limit and lower spending. It's a GOP controlled House. It was a very slim vote. I think they got it by about 2 or 3 votes. They lost 4 Republicans, which was the max number they can. But it's been televised and forecasted that there's zero chance really that the president even considers this or passes the bill. So the key there is what it is. It's more of a bargaining chip, right? So there's no reason for the Democrats to even come to the table for discussions with the Republicans if the Republicans' ideas can't even get out of the House that's controlled by the Republican Party. So that was getting it out of the House at least brings them to the table for discussion. So it's a bill that was passed that will not look anything like the final bill likely. But what it does is allows for further negotiations here. Most experts, based on the way the spending is looking right now, we're still operating under those extraordinary measures, and that'll continue until we at the actual max debt limit. And so that's looking at right now forecasting again, there's so many variables that go into that, but somewhere around that June to September date. So we still have time for them to continue to, bounce back and forth on ideas, but it's something that we're keeping an eye on. And obviously the closer we get to actually reaching that debt limit, the more of the impact that will have on the urgency for the politicians, as well as the impact on the stock market, as well as our credit, right? So that's the thing that everybody knows and markets know that this is something that happens every time nowadays, and it's just going to wait and come down to the last hour likely. So there's not much fear or panic now, but as we get closer to reaching that debt ceiling limit, that's when we kind of have more of the volatility in the market and the risk of a credit downgrade for the U.S. Debt, which would happen, I think, what was it, 2011, something like that. So.
And also like Kyle's talking about the debt ceiling limit. So again, it's a fiscal number. It's not a date and time. So again, it's not like June 15th is the day. It's when they run out of money, basically. That hey, we can't borrow or like I say with the government, they actually don't have any money. They just borrow it from us. So when they borrowed up to their max, whatever day that is, then that's the debt ceiling limit right there. And then if they don't have anything in place to go beyond that, then things shut down, or you could get a credit downgrade. And again, this is all, the market will react accordingly, and it did in 2011. But we're pretty, I think everybody's, very confident that they're going to do this. They've done it. Like I said, I think we said last time they've done it 100 times since World War II and 22 times over the last 25 years. And, today is the last few years is a lot different than 30 years ago. This just seems to be an ongoing, political dance that we're just going to do every year, whenever it comes up. So, but it's in the news, and it will affect the markets in the short term. In the long run, it's probably not a serious issue that I would be worrying about if I was invested for 3 to 5 years, like a full market cycle. But it is something that you hear about, and we want to talk about it a little bit.
Well, I think in the interest of time, we try to keep these monthly market matters to that, 10, 15-minute windows. And our quarterly roundtables is where we kind of get a little more long-winded here and go around for about an hour. But anything else coming up that you're aware of, Adam, that we have on the calendar here? Anything we want to kind of forecast? I know that we have our quarterly roundtable coming out next month, so that'll be a little bit more long-winded one, as I mentioned, and more detail on different things that are, feedback and questions that come in from our clients. So encourage you to go to strongvalley.com, and you can find it under the resources tab there, under videos or podcasts. You can see our past monthly market matters or our quarterly roundtables. But
yeah, if you have, I would just say if you have things for the quarterly roundtable, I mean, again, we love to talk about things that people care about. Again, we don't have all the answers, and a lot of these things are, a lot of factors influence, but we do watch it every day and have a pretty good idea. So if you do have questions that you want us to answer or things you want us to talk about, we're happy to do that. We always try to do most common client questions, because we are talking to clients daily, and we do hear a lot of the same things, and that's why we repeat them on the roundtable. But we love doing those. We'll have everybody here for that, and that's it. So look for that mid-May, and until then, we'll talk to you next time.
All right. Thank you all.